Good afternoon and welcome to today's webcast brought to you by Compliance Week. I'm Jacqueline Jager, Assistant Editor of Compliance Week, and I'll be hosting today's webcast. Today we are going to be talking about tips for a successful year-end. Before we hear from our guests, let me quickly go over the agenda for this afternoon. We are scheduled to go for 1 hour. I'm going to give a very brief introduction and then we'll jump right into the presentation sponsored by ADP. That presentation will be followed by a question and answer session. Your questions will be kept confidential and anonymous, so please don't be shy. You can ask your questions at any time using the Ask a Question function on the left-hand side of your screen, and I'll pose them to our guests at the end of their presentation. After the Q&A, I will wrap up the webcast. This webcast will also offer CPE credit for all attendees. Please disable your pop-up blockers in order to access the exam. To obtain your CPE credit, wait until the webcast is completely over and I sign off. At that point, the final examination will be presented automatically in a separate window. Again, please ensure your pop-up blockers are disabled. If you have trouble viewing the CPE test or receiving the CPE certificate, please send an email to info@complianceweek.com to request a copy. I'll repeat these instructions at the end of the webcast, so if you missed anything, don't worry. A few other administrative details. At any time during the presentation, listeners can download the slides from the drop-down menu on the left-hand side of your screen. You can also hit the View Slide Full Screen button at the bottom of your screen if you wish to increase the size of the slides. And lastly, a Help button is located in the upper right-hand corner of your screen for assistance. Today's webcast is part of a series that Compliance Week launched a few years ago. We hold these webcasts just about every week, usually on Thursdays. And our guests have included Chief Compliance and Governance Officers at leading public companies and experts on various compliance, regulatory, governance, and risk topics. I'm not going to read the upcoming schedule, but you can visit www.complianceweek.com for details or to register. So let's get to our program. Please welcome Wendy Seyfert, Vice President of Agency Relations at ADP, a 23-year veteran at Automatic Data Processing. Wendy has worked to strengthen the ties between organization and various government agencies. As the Vice President of Agency Relations in ADP Added Value Services, Wendy leads a team of 35 associates who service more than 500,000 employers who use ADP's tax filing and depositing service in thousands of jurisdictions. Wendy has spent most of her career at ADP with 20 years in agency relations, ensuring compliance for tax jurisdictions, child support and garnishment payment processing, new hire reporting, and benefits claim processing products. As the Vice President of Agency Relations, Wendy leads multiple departments that negotiate and interact with thousands of state and local government agencies to determine ADP compliance. Wendy, we are very glad to have you here, and I will hand the floor over to you.
Thank you, Jacqueline. I'm happy to be here. So good day, everybody, and thank you for coming. I know you were looking at a rather dark and ominous PowerPoint presentation before you. I think most of us prefer light and airy themes. But given the complexity of year-end, the plethora of changes that always appear to be crossing our paths, and the proximity of Halloween, we went with a more Edgar Allan Poe theme. Payroll tax is scary, and navigating the obstacles of it, especially at year-end, can be overwhelming. So I hope during our time together that it will make it a little bit less mysterious and provide some clarity for what you need to pay attention to. You'll see throughout the presentation that I have links embedded for key forms or websites that you'll want to refer to or even save as favorites. Obviously, in a presentation such as this, these links won't work now, but the downloadable version you'll be able to access will let you get to these later. So it's nice to see we're in good company if we're confused. We're in a specialized field with employment tax. I shudder to think what Einstein would have said if he knew what year-end 2014 was going to look like, with FUTA credit reduction and the dreaded BCR add-on. But I'm getting ahead of myself. We'll get to that later. Mwah. So here's our agenda for today. We're going to cover some 2015 changes to make sure you're up to speed, as well as some 2014 changes of significance in case you missed them. In the world of the IRS and SSA, this will include common forms we deal with, W-2s, 941s, and 940s, as well as the new third-party sick pay form, and then talk about some limit changes coming up in 2015. And I'll speak briefly to some year-end filing forms you may have heard about related to the Affordable Care Act. We're going to then move over to states and locals, covering Ohio and Pennsylvania and those wacky locals there. For states, we'll go through recent changes to filings, as well as make you aware of some new requirements so you can stay out of penalties. I've included a maybe, maybe not section, upcoming legislation or imminent changes where I want to make you aware of high visibility pending items that could hit you by surprise or at the last minute. Then we'll close with a top 10 to help you make your year-end successful. Don't be surprised when we run into some knowledge checks to make sure you're staying with us, as well as ensure that those of us with our CPP or FPC certification keep our credits up. All right, then let's begin with what is happening with federal form changes. I thought I'd ease us into our time with something that isn't quite so foreboding, something we're all familiar with, the W-2 and W-3. There aren't any significant changes this year, just some box title changes, and I threw in a few reminders. Note the varying due dates that still apply on the right. I also wanted to mention that there's a federal budget proposal that includes accelerating filing due dates to prevent refund fraud. That hasn't passed yet, but has been proposed for a few years now and is gaining momentum outside the budget process. So put that in the back of your mind and consider any impacts that it might have for you if it ever passed. If I were a betting woman, I wouldn't be surprised if we see end of January due dates for all forms, given our almost fully electronic world. Note that the email address requirement will not be enforced for 2014 for electronic filings. The reason for consideration of the address is it would allow the SSA to notify an employer that there was a failure with the employer copy of the W-2 filing. They are delaying implementation and may make it permanently optional because of the difficulty to enforce employers to provide it, as they are realizing. What is changing is Social Security Administration's, or SSA's, acceptance of W-2s. I've used the word return, the same word they use for what they'll do with W-2s that they won't accept. But essentially, these are being rejected and must be resubmitted. SSA is monitoring wage reports more closely for invalid conditions as part of their overall system redesign. If you have an invalid record format, the entire file will be rejected and need to be resubmitted once the errors are corrected. Details on what constitutes an error is based on AccuWage. So here's your hint. If you aren't using AccuWage already to check the formatting of your file, you may want to start. AccuWage software is available through the Business Services online site within the SSA site, to which I've provided a link. Also, for this year and beyond, they have updated the algorithms they'll use to determine whether a submission is a duplicate of a previous submission. They will now be using more detailed analysis, including hash totals for dollar item entries, which will ultimately result in fewer submissions being erroneously rejected as rejects. Hooray! Their false duplicate rate currently is too high, and SSA prefers to err on the side of accepting more data because of its long-term impact on benefit payments. The downside with accepting more is that this could create more out-of-bounds conditions that are actually duplicates, which might mean more notices. So boo-hiss on that one. A slight modification so far for the 941 for 2015, which probably only affects a few of you out there, is the COBRA adjustment lines 12A and 12B that were deleted from the paper form for 2014 but left in the e-filing schema. They had to do that to accommodate 2013 filings. The schema will now be changed for 2015. You may know this already, but just in case, the process of taking the credits is via the adjustment process on lines 19A and 19B of Form 941X, the amended return form. These are the same lines used for reporting other adjustments, so no change to that form. We do have a new form this year, and we haven't seen before, Form 8922, which will replace the recap W-2 that was used in prior years. Previously, you sent the recap to the SSA, but now it goes directly to the IRS. Either the insurance company or the employer needs to file this, whichever one needs to reconcile their withholding against their Forms 941. I've listed out the items that will need to be reported, and we have a sample of the form and where you can find the draft so you can start to see what it looks like. For independent contractor and other non-employee reporting, we only have a couple of changes. There's nothing new on the 1096 or 1099 MISC or any of the due dates, and just one new box in the 1099R. I do want to highlight that there's been a lot of talk about truncation lately. We're all very concerned and cautious about releasing confidential Social Security number information out to the world, and the IRS is no different. They released final regulations regarding taxpayer identification numbers, or TINs, this last July. What started as a pilot program for 1099 payee statement in 2009 is now allowed on recipient statements, but you still have to remember to not truncate on the agency copy. These new truncation rules apply to Social Security numbers, taxpayer identification numbers, adoption taxpayer identification numbers, and employer identification numbers. When truncating a TIN, you would only display the last 4 digits. For example, XXX, XX, and then the last 4 positions of the TIN. Remember, the truncated taxpayer identification number, also known as a TTIN, is allowed only on the payee's copies, paper or electronic, of a form. A payor may not truncate their own ID. And as stated before, truncation is not allowed on the employee or employer copies of the W-2 or W-3. Legislation would be required to make that happen. Overall, just remember, truncation is permissible but not required where it's allowed. It's hard to believe that you can use the words easy and 940 in the same sentence. When I first started in payroll tax, that was the ultimate form to fill out manually, like a very difficult final exam. Or maybe it was a test to see if I could handle payroll tax. I thought I'd cover the basics first. Both the 940 and its corresponding schedules are not finalized, a common theme when you're still in October. But there are no significant changes to the drafts that we have seen. These drafts aren't available to the public yet, but ADP was privy to see the early versions. But credit reduction, in all its glory, has not gone away. Where's a flashlight when you need it? I expect to see the headless horseman coming down this path. If you're just joining us in the payroll tax world, welcome. I thought I'd briefly go over FUTA credit reduction as a reminder to the new and the not so new of us. This is a reduction of the allowable 5.4% tentative credit that employers can take on the tax due, and as a result of a state taking a federal loan to meet their unemployment obligations. In other words, when they run out of money to pay unemployment claims. States have 2 years to repay the loan, and if they are unable to repay the loan or meet credit reduction avoidance criteria by November 10th of the year their loan is due, they may become what we consider credit reduction states. The Department of Labor mandates credit reduction states in a joint effort with the Department of the Treasury and the IRS after the November 10th deadline. For 2014, the standard FUTA calculation is the 6% FUTA rate minus the allowable 5.4% tentative credit, which equals the 0.6% final FUTA rate. Some of you probably remember that the total FUTA rate used to be 6.2% because of a 0.2% surcharge, but that went away in July of 2011. However, for those states with outstanding loans beyond their 2 years, the credit reduction chips away at that allowable 5.4% credit, a little more being reduced each year. I have a slide in a little bit I'll show you with the most up-to-date anticipated rates, but have listed the states here that appear on the Department of Labor's website as of this last Monday. One state, South Carolina, did file an avoidance application, though, but no final decision has been made. Let's let that sink in and take a quick knowledge check before we talk more about what happens this year with FUTA taxes. Hopefully you were paying attention while I was throwing out all those numbers So here's where we have some audience participation. What is the net FUTA percentage when an entire credit is received? Is it 6%, 5.4%, 0.6%, or 0.06%? So I'll be watching for your survey details and how you guys vote. All right. Nice job, everybody. It looks like everybody had the right answer, which is 0.6%. FUTA is calculated by taking the total FUTA rate of 6% minus the full credit amount of 5.4% to equal a net of 0.6%. That 0.06% was kind of a throw you there. All right, and one more question. Which of the following applies to the FUTA credit reduction? Is it mandated by the Department of Labor, reported on the 940 return, charged as an additional tax assessment on the FUTA employee taxable wages for that state, or all of the above? Let's see how you guys do on that. Go ahead and vote. Wow, you guys are really good. So the correct answer that most of you got is all of the above. Answer D. Nice job. All right, and here's the twist. There is tentative credit, which is different than credit reduction, but could affect your FUTA tax rate every year. Sometimes we know this in our head, but the language around it can be confusing. In a perfect world, you get this tentative 5.4% credit for timely unemployment insurance tax payments to states throughout the year, giving you an adjusted FUTA rate of 0.6%. Every year you report this on Form 940, and the allowance of the credit is subject to review by the IRS. But not everyone is eligible to receive this 5.4% credit. If you are late with a quarterly payment to your UI tax agency, or the payment goes completely missing, or if you're in a state where certain wages may not be subject to state taxation but are subject to federal taxation, then those wages in those scenarios make you ineligible for the 5.4% credit. In the example I have here, there was $1 million of the total $3 million that were not eligible for the tentative credit. So those must be taxed separately, leaving a total federal unemployment tax bill of $72,000. If all of those wages had been subject to the credit, the tax bill would have only been $18,000. You can see how important it is to monitor your tax payments, as well as make sure your taxation calculations for eligible wages are correct. And here's the really scary slide. So scary it's just all black. This year end, there is yet an additional item that could cost you extra tax dollars at year end, depending on your state. The benefit cost ratio, or BCR add-on tax. After the fourth consecutive year of being subject to credit reduction, there is an additional add-on that a state's employers must pay. I think of this as the, hey state, you weren't able to repay the loan on your own or with credit reduction, so now we're taking serious measures add-on. To avoid the BCR add-on, states have had to pay off their loan or requested a waiver from the Department of Labor before July 1st of this year. With this request, they also had to meet the requirement that there not be a net decrease in solvency in the state UI trust fund for the period from October 1st, 2013 to September 30th, 2014. Several states submitted waivers, and some states are still trying to pay off their loan amount entirely by November 10th. That leaves 5 states that have not submitted waivers, and some consider unlikely to pay off their loans by the due date. Those states are Arkansas, Connecticut, Delaware, Georgia, and New Jersey. None of this will be solidified until after November 10th, so watch closely and be prepared. Here's the slide I promised you earlier. It's taken from the Department of Labor's website. But again, these numbers won't be solidified until after November 10th. This shows the potential credit reduction for states with outstanding loans. You can see that in the first column to the right of the state name. Then we come to the estimated BCR add-on column, not adjusted for states that have submitted waivers, leading to the total credit reduction in the state. So you take the 5.4% credit reduction an employer gets under good circumstances and subtract the amount in the far right column, add that to 0.6%, and voila, you have your FUTA tax rate. Data changes on this all the time, so consider making this URL in the bottom right as a favorite for the next few years until we're out of credit reduction entirely. While a final number hasn't been published yet, the Social Security taxable limit is estimated to be $118,500, up $1,500 from last year. This means we'll take home another $93 less in our paychecks next year. Medicare remains unlimited, as do the Medicare tax rates and limits for the additional 0.9% tax on high-income earners. Sitting where we are in the middle of October, we are right on the cusp of receiving the 2015 contribution limits for a variety of areas you care about, such as qualified pension plan contributions, federal withholding allowance amounts, adoption assistance limits, qualified transportation limits, and standard mileage rates. I struggled with how to get this to you and settled on providing you with some guidance on how to sign up to get these on a regular basis. Now, let me warn you, you could easily be inundated with correspondence. So you may have to monitor what comes from where, and if you're receiving information in droves that you don't care about, you can unsubscribe from the service. But the IRS has made a few sites available that will help you with this on an ongoing basis. The primary website is at the top of this page, the e-news subscription site in the red box. From there, you can choose what information you'd like to subscribe to. I have a few suggestions here. E-news for payroll professionals is my first recommendation. This will give you information specifically for federal payroll tax returns. Under employee plans, you may want to subscribe to the retirement news for employers. This is designed for business owners and their tax advisors to provide practical retirement plan information. If you are a smaller employer, you may want to consider the e-news for small business, which provides information about IRS outreach products and programs. And if you're not small, you could sign up for the e-file news for large businesses. Isn't it nice? These are so simply titled. To subscribe to any of these, just follow the links from the description, enter your email address, and click on what lists you want. And I have listed the 2015 limits for HSAs since those were available. And just a few words on changes related to the Affordable Care Act, also known as ACA or health care reform. As you've noticed, this is a very phased-in approach. So the newest phase for employers is you need to have your strategy in place by the time open enrollment begins later this year for your 2015 plan year. Beginning January 1st of 2015, if you have 50 or more full-time employees, full-time being defined as 30 or more hours per week, plus full-time equivalent employees, you must offer affordable minimum essential coverage of minimum value or potentially be subject to tax penalties. I say potentially because it will only happen if an employee goes to an exchange and is found eligible for a premium tax credit, then the IRS will issue penalties. And you can believe there will be a whole lot of paperwork involved in the back and forth of proving coverage was offered, declined, or whether or not the employer feels they were mandated. Penalties will not be imposed in 2015 on employers with 50 to 99 full-time employees and full-time equivalents, as long as those employers do not restructure their workforce or change their health coverage in 2014, 2015, or for non-calendar year plans that go July to June, for example. And heads up on some forms you can start to file this year if you want to test your system, though they aren't mandated until tax year 2015 due in 2016. Forms 1094C and 1095C are coming. Think of the 1094C as the employer transmittal and the 1095C as the employee detail. Due dates vary depending on whether paper is filed or if it's filed electronically. These forms are in draft and not expected to be finalized until the end of December 2014, so keep watching. And to help you with this, I've included a link to IRS's site in case you want to watch for changes here. before we move off our federal topics, I want to go back to something about the federal budget. We've all seen the dysfunctions over the last few years, or more specifically, we've probably heard about the wranglings in the news when Congress fails yet again to pass a budget. Recently, we had another continuing resolution proposed, passed by Congress, and signed by the President. The federal fiscal year budget expires at the end of September, and when a new budget isn't passed, we have the potential for a government shutdown. Remember last October when national parks and other services were closed? I was in South Dakota at the time at a state workforce agency conference, and there were police actually keeping us from looking at Mount Rushmore. So currently, we're operating under yet another continuing resolution. This one expires December 11th after the midterm elections, so we have a couple of months before we do the dance again. Okay, enough about feds. Let's move on to some local and state changes that have either recently happened or are coming soon. Since locals always get left to the last, let's give them an ego boost and start there. We're specifically going to address locals in two states, Ohio and everyone's favorite, Pennsylvania. House Bill 5 in the Buckeye State is felt to be an overdue bill and is an attempt to simplify what some say is the nation's most complex system of municipal income taxes. Businesses that do work in multiple cities, for example, have to file in multiple places. What is stalling this is that municipality governments are concerned that the tax-cutting provisions within the bill will cut their revenues. So those details are still being discussed at length. So while all this is being worked out, the original anticipated start date of this January will most likely move, and our contacts at the Ohio Municipal League say the process will have to start all over again if the end of the year comes and goes. Act 32 in Pennsylvania can give us all a shudder, eh? When was the last time you remembered the number of a piece of state legislation 4 years after it passed? So it isn't new, but I know it still causes us a lot of great angst, so I thought a general reminder would be helpful. This was also a uniformity bill designed to significantly reduce the number of collectors in the state and not have a free-for-all amongst the earned income tax and school district taxes. The primary things to remember are withhold at the higher rate if the residence and worked-in rates are different. Political subdivision codes, or PSD codes, are required. These help the collectors know where the residence and worked-in locations are. And when you hire a new employee, make sure you get a residency certificate to help you with the PSD process. This will also give you a better chance at a valid street address, and I'm seeing collectors be very, very picky about this. And if you aren't familiar with it, here's a link to the DCED website. It's very well organized and has great information out there in one location. But remember, you won't find Philadelphia anywhere on here. Philly operates under the Sterling Act, so it was not included in Act 32. The time for a knowledge check. For Pennsylvania Act 32, if the resident and worked-in rates are different, what should an employer do? Withhold at the higher of the two rates? Withhold the lower of the two rates? Withhold the average of the two rates? Or move out of the state so I don't have to figure out Pennsylvania local taxes? So go ahead and vote now. And here come our results. You guys are just brilliant, although I see we have a couple of funsters in the crowd also. So yeah, you could do D and move out of the state. That might be a little extreme, but the correct answer is A, withhold at the higher of the two rates. So for our state updates, I couldn't pick everything, so I've chosen what I think are the most relevant and most recent updates to share with you. Alaska had a recent change where they lowered their e-file mandate to all employers with 50 or more employees. You may have already seen this in other states where the threshold is 0, so don't be surprised at the continual decrease of thresholds for electronic filings. Out here in beautiful California, they have done something not so beautiful and increased their penalties for late filings and deposits. So make sure you're using a valid account number and depositing thoroughly and timely. This funding change is to help restore the EDD service level to employers, allowing them to retain staff and continue to support the processing of new and continued claims. In the District of Columbia, the UI agency is implementing a new system and throwing a lot of new requirements for filing into it. Their initial e-file design, which was supposed to go live in third quarter but is now required as of fourth quarter, will apply to even small employers. There are several new data elements in their specifications that I wanted to tell you about. Things like employee coding for family relationships to the corporate officer. They want to know who is a sister, cousin, etc. This is what you might say rather unique, but fortunately they've recently told us they will default to worker in the absence of more specific information. Phew. They will also ask for hours worked, similar to Oregon and Washington, we believe, and will require any third parties that might be responsible for filing and paying your taxes, like an ADP, to be authorized by the employer. You've seen that in other states like Minnesota, Massachusetts, and New Mexico. In Florida, the UI filings and payments are handled by the Department of Revenue, in case you're wondering why it says Revenue and UI about the same agency. House Bill 7023, enacted earlier this year, removes the December 31st, 2014 expiration date for the installment payment option for quarterly unemployment taxes. As in years since 2011, employers can choose to pay by installments for any or all of the first 3 quarters in 2014 if they submit the employer's quarterly report, Form RT6, either paper or electronic, make payments on time, and pay a $5 annual installment fee. As a reminder, the first quarter tax due is divided into 4 equal payments, the second quarter into 3 equal payments, and the third quarter into 2 equal payments. There's no installment option for the fourth quarter. In Maine, they're making some major changes starting in January. They will no longer have combined reporting, but have split the unemployment and withholding filings. This doesn't change the electronic filing mandate, which is required for everyone, with a $50 penalty for filing on paper. In the Silver State, we are just moving into our third quarter of a 3 to 4 year bond assessment to help them pay off their federal loans. It's a separate form, and the rate varies depending on your taxable wages, and all contributory employers, those subject to UI tax, are required to pay it. Nevada also wanted us to remind everyone that the CEP rate will remain at 0.05% next year. Puerto Rico is always a jurisdiction that stands by itself, if you know what I mean. So while I wouldn't normally mention something like a form change, they have been doing so much change lately that I thought I'd help you out in case you're lucky enough to have Puerto Rico employees. In prior years on the W-2 PR box, 16 was for salaries that were exempt under Act 324, which was for public employees working overtime during disasters. Now for the 2014 form, Box 16 is expanded to include other types of exempt overtime, so check that out. Last year, Box 5 was used for the date the employee started receiving pension, and Box 6 was for the cost of the pension or annuity. This year, those fields were moved to Form 480.7C, which is a 1099 equivalent. So if you weren't filing this 480.7C before and you have pension payouts, you will need to file it now. The Rhode Island Department of Labor is reducing their job development assessment rate effective January 1st, so it's nice to see a positive sign for employers. In Washington, there is now a new 12-digit number that began appearing on tax correspondence this past spring. The Employment Security Department is currently developing a new online filing system and revising their quarterly unemployment reports. The new 12-digit ESD number will not be required until this is complete, but during the registration process, they are starting to assign this new number. Effective in 2015 in West Virginia, employers who hit the 100K threshold of liability in the prior year have to make an accelerated payment for the June liability of June 1st to June 15th and make that by June 23rd. This means there are 2 payments due in June, the regular May payment and then this accelerated payment for the partial month of June. This is because Senate Bill 331 was passed in order to capture additional tax revenues prior to the state's fiscal year close. Some of you may recall Mississippi did this a while back also, so not completely new. There is a reduced electronic filing mandate for the C-101 and C-147 reports in Vermont. I told you to watch out for this, right? Once an employer is registered, the Department of Labor will provide an employer password. Instructions and help menus are also available when using the online application. Vermont does allow for hardship waiver, but you must call them directly. All employers with over 5 employees must e-file. Paper will be accepted if you don't have an account number, but if you do it for more than 1 quarter, you'll get hit with a $100 paper filing penalty. Vermont also increased the health care contribution assessment from $119.12 to $133.30, effective the last 2 quarters of this year. In Virginia, the due date for annual filings changed through recent legislation. For W-2 and 1099 wage statements due in 2015 for tax year 2014, as well as the VA6 and VA6H, the due date has been changed from February 28th to January 31st. February 2nd next year because the 31st is on Saturday. The earlier filing date will help them to ensure faster and more accurate processing of individual income tax refunds, plus help them with individual tax filing fraud prevention. And finally, for the states that we know of as of this last Tuesday, I've included the new wage basis for the states. So far, there are 15 that have increased, 27 that are flat, and 2 that went down. Yay. I'll let you glance at this a little bit, but remember, this will be available as a download later. Do we dare to cross over to talk about some potential changes? There are 3 I pulled out that you should watch for because of their significance. We will tread carefully. First, in our maybe, maybe not file, the Expire Act from April 16th of this year. The Joint Committee on Taxation wrote the Expiring Provisions Improvement, Reform, and Efficiency Expire Act, which extends about 50 expiring tax provisions. One would have a significant impact on employers, the reinstatement of the parity for exclusion from income for employer-provided mass transit and parking benefits. The provision would extend the parity of the qualified fringe benefits for 2 years through December 31st of 2015, as well as increase the 2014 monthly exclusion for combined transit pass and van pool benefits to $250 to make it equal to the exclusion for qualified parking benefits. Wow, that's a mouthful. The proposal applies to months after last December, which would make it retroactive back to January 2014. This isn't a done deal yet. The Senate Finance Committee approved the act, but the Senate needs to review it. The House Ways and Means Committee will also be reviewing the list of expiring tax provisions. While no timetable has been set for any action, it appears likely that the transit parity will be reenacted, so be prepared to make those adjustments. A proposed amendment to the Act would also permit application of credits, such as research and development, against payroll taxes for certain qualifying employers. Form 941 would be revised to report the credits and may result in some errors and penalties for the incorrect application of credits, resulting in payroll tax deposit shortages. Rest assured, there are industry groups out there working with the IRS to ensure that any reconciliation of the credits be applied against the income tax rather than the payroll tax. And then a couple of state updates that haven't happened but that you should be aware of and watch if you're located there. Those of you in Illinois are aware that last year they implemented, after very swiftly passed legislation, mandated monthly wage reporting in order to help the state with Medicare fraud. New Jersey also has legislation introduced that would require monthly wage reporting. I'm not inclined to say which way it may go. I think it's very much up in the air, but you're going to want to keep an eye on this as more states could follow. Legislation had passed the New York Assembly, but has since been referred back, so it's not quite implemented yet. If passed and signed starting in 2015, New York employers will no longer have to provide annual wage notices to existing employees. The annual wage notice duty was imposed on employers as part of the Wage Theft Prevention Act, or WTPA, which passed in 2010 to remedy supposed abuses of the state's wage payment laws. The WTPA required, among other things, that each year all New York employers provide written notice to existing employees detailing certain wage-related information. The bill eliminates this cumbersome requirement, but the remaining provisions could remain intact, and the bill actually bolsters several other wage-related safeguards. It increases the penalties on employers that fail to distribute a wage notice to new employees, providing authorization to levy a $50 penalty per work day, formerly a work week, per worker on an employer that failed to provide a proper wage notice. The New York legislature was recently in recess, but there still isn't any movement on the bill, and it's not been transmitted to the governor. According to a representative from the Assembly Public Information Office, the governor has 10 days from the date a bill is transmitted to either sign it or veto it. And if no action is taken within that time, it automatically becomes law. So we're going to wrap this up with my top 10 tips for a successful year-end. For those on Twitter, you can find these also at #year-end. Tip 10, don't ignore those agency notices. Besides just asking for general trouble, leaving open year notices unresolved could create more problems for you when you file annual returns. I would also include that you don't ignore unresolved e-file rejects also. Those will create problems when you go to file your annuals and could identify issues that you'll have again with an annual e-file upload. Number 9. Similarly, if you have adjustments to make for the current tax year, make sure you file those in plenty of time for the agency to post them before your annual returns are received. In other words, don't wait until the end of the year and take a chance on how quickly an agency will be able to get to your filing. Number 8, as you've probably been seeing, agencies don't have the tolerance for missing registration applications that they used to have. As they've automated their systems to increase efficiency, they don't want to manually handle returns that are outside these automated processes. And fortunately, getting a registration number isn't the time-consuming process it used to be, as many states have portals and many third parties will assist with that process. Make sure you are using, or your service provider is using, valid account numbers only. Number 7, whether it's your 941 and W-2s or any quarter to annual return, make sure that your totals for the year add up to what you reported each year. Number 6, don't neglect the numbers within your returns also. Watch for negatives in data fields that shouldn't have them, and make sure tax fields are not higher than wages. Common causes of discrepancies within Form 941 include negative figures for federal income tax or Federal Insurance Contribution Act tax, negative figures for Medicare or positive earned income credit, negative third-party sick pay, Medicare wages less than Social Security wages. A little time to review the numbers now will save you notices and possibly penalty later when it will be harder to find the details you need. Tip number 5. Even if you are diligent with your quarter and annual balancing, you might get a notice called a CAR, or Combined Annual Wage Reconciliation Notice. So here are a few suggestions on what to do that are taken from one of our IRS liaisons here at ADP. First, always request a hold on the account. Don't wait with any agency as, depending on their cycles, which vary, you could be faced with an escalation to collections or a lien levy situation. For notices from the SSA, you can check with the business services online to get a glimpse of what might be wrong. But you may have to call if they've made an internal adjustment to your filing that isn't visible. Request an ERQY print, which stands for Employer Report Query, to help you identify those. And for 941 notices, you can self-identify these through something called the Payer Agent List. This can be used when you have a car out of balance situation and the data that IRS has is higher than what it should be. The Payer Agent List will help prevent employee notices if they haven't already received one. This list alerts the IRS examiner that there's a known problem with the W-2 filing and it's not just an intentional underreported issue. Number 4, if you didn't alert the IRS through the Payer Agent List process, or if you have an employee standing in your office because of problems they've had when filing their 1040, there are some additional steps you can do. After making sure they've received any corrected copies of Forms W-2, provide them with the details on what you did. This is easier than trying to create that months later when they're in front of you. Just like what you would do with an employer notice, advise the employee to have a hold placed on their account while they figure out what happened. Number 3, we all do a lot of e-filing these days. So in addition to the balancing and figure checks we talked about and resolving current year notices and amendments, it's important that your basic profile information is correct. In a paper world, a lot of times an agency can research and resolve it without you having to get involved. But in an e-file world, it's a system that your return's going through. And if these basics aren't right, you could automatically put in a notice or penalty situation. Number 2, with all the moving parts with FUTA, it's even more important to make sure you don't lose any of your tentative credit because of taxable wage problems between your UI and your FUTA wages. And last but certainly not least, to aid with the successful posting of W-2 filings and employment tax reporting, all employees must have a valid Social Security number and name format. Invalid information may result in rejected filings and the possibility of associated penalties. One way to keep from having this problem is to use the Social Security Administration's Social Security Number Verification System, SSNVS, with every new hire to ensure you have a good active number and it matches the name of your employee. And here's the URL to that site, which will allow you to check them one at a time, or there are instructions for how to do that with a batch process. So on to our final knowledge check. Which of these should you not do to ensure a successful year-end? Resolve all open year notices before the end of the year, complete all open year amendments before the end of the year, make sure all filing numbers you use are accurate, balance your quarterly returns to your annual return, have a valid account number in each jurisdiction so you don't have to use an applied for ID, watch for key problems such as your taxes being higher than your wages, similarly watch your UI taxes are not less than FUTA, cross your fingers, or ask Santa for a happy year-end. Can you figure it out? Bingo. Nothing getting by you guys. You got it. So hopefully you figured out which ones are not the correct answers. All are good advice, but H and I aren't going to help you as much as the others. So thank you so much for sharing this hour with me. It's really been a pleasure. I always love being around people that are passionate about the same things I am. And I know that payroll professionals, more than many others, care deeply about their job and are constantly in a learning mode. So I'm going to turn it back over to Jacqueline for a minute or two, and then we'll have a little Q&A.
Great. Wendy, thank you so much. That was a very informative session. And again, for our listeners, that was Wendy Seyfert with Vice President of Agency Relations for ADP. If you would like a copy of the slides just presented, you can download it from the drop-down menu on the bottom left-hand side of your screen. And we are going to move right into the Q&A part of the session. I'm going to throw some questions out to you, Wendy, in no particular order.
Okay.
Question number 1. I am a little bit nervous about why the SSA is going to start rejecting forms for invalid conditions. What do I do if I disagree with what they have rejected?
Yeah, I'm always a little nervous myself when I start to hear that new rejects are going to happen. So my first question would be whether or not you used AccuWage or not, because that definitely will identify you the situations that can cause a reject. If you didn't use AccuWage before the filing and you get a reject, you can still go back and use AccuWage to identify all the scenarios that could cause a reject. So obviously that means you're going to want to try this and try filing a few days in advance of the due date. And then if you still disagree with what they're saying will be rejected, you're going to have to call the Social Security Administration directly.
Okay, thank you. Next question. I heard that the net FUTA rate may go up to 0.8%. Is that true?
I've been hearing that similarly too. It's true there's been discussion within the proposed federal budget, and that's a couple years old at this point, to permanently tack back on that FUTA surcharge of 0.2% that I'd mentioned earlier in the presentation. However, there's no reason to believe one way or another this is going to happen, and almost none of what's been proposed in the budget a few years ago has moved along. And that includes also, you may have heard that they're talking about raising the FUTA taxable wage limit above that $7,000 threshold, and that'll have a trickle down to the states that are at $7,000 also, but nothing yet on that.
Okay, thank you. Next question. Your slide on FUTA tentative credit, unrelated to the credit reduction, caught me off guard. It sounds like you're saying that if I'm late with my UI payments, or that the taxability of something like executive compensation is different between the state and the IRS, then I don't get the 5.4% credit. Is that true? How would the IRS know that?
Yeah, it's really true. It's scary to think about, and I'm guessing some of you actually haven't seen your tentative credit retroactively removed when you've had these scenarios, but I just wanted to make you guys aware, in a perfect world, yes, that would be true. It's an honor system primarily with the IRS, and you're expected to self-report when this happens. It, however, could come up also in the annual FUTA matching program the IRS does with the states. So while it may be more unlikely, it is always a possibility. So I just wanted to do full disclosure to you guys.
Okay, next question. When will we find out if states that haven't repaid their loans are going to be subject to that benefit cost ratio add-on?
Yeah, so that November 10th date is key for everything. The BCR add-on is also determined, as well as the states that are going to have credit reduction. So it doesn't mean that, come November 11th, we're going to know everything. And the government is closed for Veterans Day that day also, and hopefully some of you are off. But the IRS, Department of Labor, and Treasury, all know employers are anxiously awaiting this information, so I wouldn't expect it to be too long after that.
Okay, we have another question in. You mentioned when you were talking about the District of Columbia that if I have a third party doing my payroll processing, that I will have to register them. Do you have more details?
Yeah, I'm really glad you're paying attention to that, especially as a payroll processor. It's good that you're listening. The details on how to enroll a payroll provider or third-party agent, as they're called, are still being worked out. So some of you may know if you have a third-party provider like ADP doing your processing, states can have a very difficult process, like in Massachusetts, where your provider is prohibited from sending money and forms if the employer hasn't authorized them correctly. Other states, like Minnesota, who's been up a while, has a smoother process, and they allow what is called a passive enrollment, whereby the third party can do that for them, and it doesn't stop the payment or the filing from going through. So I don't have any more details other than that at this time. We're watching it closely. We'll try to make it in our conversations with them as painless for employers as possible. Okay.
We have time for one last question. If my employee gets a notice, you provide some guidance, but what am I required to do as an employer?
Yeah, good question. If you're asking me if there's a list of obligations that an employer has to the employee in assisting them with their notice resolution, there isn't. You're obligated to file correctly, and in so doing, you have to provide those details of what you've done with the correction. It's really more a matter of maintaining your ongoing relationship with the employee.
Okay, wonderful. Well, thank you very much again for that very informative session. And again, everybody, that was our guest, Wendy Seyfert, Vice President of Agency Relations for ADP, and a special thanks to ADP for making this webcast possible. This webcast has been recorded and will be available sometime in the next hour or so. CPE credit is now available to subscribers for archived webcasts. Please check out our on-demand CPE library under the webcast tab at www.complianceweek.com. Once again, to obtain your CPE credit after the presentation, Wait until I finish this wrap-up, and please disable your pop-up blockers in order to access the exam. The webcast will close automatically, and the final examination will be presented in a separate window. If you have any trouble viewing the CPE test or receiving the CPE certificate, please send an email to info@complianceweek.com, all one word, to request a copy. This concludes our webcast, and thank you again for joining us. Goodbye.